Hey, real quick. Raise your hand if you've maxed out your 401k this year. Cool. Now keep it up if you've also maxed out your HSA. Yeah, that's what I thought. Here's the thing. Everyone in the personal finance world is obsessed with the 401k. Get the match, increase your contributions, blah, blah, blah. And look, that's not wrong. But while you've been staring at your 401k like it's the Holy Grail, the actual Holy Grail has been sitting right next to it, completely ignored. It is the only account in existence that the IRS can't touch, coming, going, or growing. I'm talking about the health savings account. And today, I'm going to prove to you that used correctly, it beats your 401k. Let's get into it. Okay, most accounts give you 1 tax break, maybe 2 if you're lucky. The HSA gives you 3, and that's not a marketing tagline, that's math. Here's how it works. We're going to call it the triple threat. Strike 1, tax-deductible contributions. Every dollar you put into your HSA comes out of your taxable income. So if you're in the 22% bracket and you contribute the 2025 max of $4,300 for an individual, you just saved nearly $1,000 in taxes right now, this year. Strike 2, tax-free growth. The money sitting in your HSA, it grows completely tax-free. No capital gains tax eating into your returns every year. No tax drag slowing your compound interest. It just grows, uninterrupted, like a garden nobody's pulling weeds from. Strike 3, tax-free withdrawals. When you pull money out for qualified medical expenses, which by the way covers everything from prescriptions to dental to vision to therapy, you pay 0 taxes. Not reduced taxes, 0. That is the triple threat. And no other account in the US tax code does all 3. Not your Roth IRA, not your 401k, nothing. Now, before we go further, I have to call something out, because most people are committing what I call the HSA Cardinal Sin. They treat it like a checking account. They contribute money in January, they use the HSA card at the pharmacy in February, rinse and repeat, and the balance just sits in cash, earning basically nothing while they feel good about having an HSA. That is killing your potential wealth, full stop. Here's what you should be doing. Log into your HSA provider, find the investment options, and move your balance into a low-cost index fund, something like a total market fund with a 0.03% expense ratio. Set it, forget it, and let it compound. Think about it this way. $4,300 sitting in cash for 20 years. You might end up with maybe $5,000 after some negligible interest. $4,300 invested in an index fund averaging 7% annually, you're looking at over $16,600. Same money, wildly different outcome. The account is just a container. What you put inside the container is what matters. Okay, this is the part of the video where your brain might break a little, in the best way possible. Here's the strategy that almost nobody talks about, the receipt method. Picture this. You have a $2,000 surgery this year. Instead of using your HSA to pay for it, you pay out of pocket from your regular checking account. Then you take that receipt and you file it digitally in a folder labeled something like HSA reimbursements. Now your $2,000 stays inside your HSA and it goes to work in the market. Fast forward 20 years, that $2,000 growing at 7% annually is now worth over $7,700. Here's the kicker. You can pull that $7,700 out anytime as a tax-free reimbursement for that surgery you paid for in 2025. The IRS doesn't care how old the receipt is. There's no expiration date. There's no rule that says you have to reimburse yourself in the same year. So what you've essentially done is invest $2,000 tax-free, grow it to $7,700 tax-free, and pulled it out tax-free on a receipt from a doctor's visit 2 decades ago. That's not a loophole. That's just the rules, if you know how to play them. All right, let's address the elephant in the room. Is the HSA actually better than a 401k? The honest answer is, for the match, no. For everything else, maybe yes.
If your employer matches 401k contributions, that's an immediate 50 to 100% return on your money. You capture that first, always, non-negotiable. But here's where the HSA pulls ahead: taxation on the back end. Your traditional 401k, every dollar you withdraw in retirement gets taxed as ordinary income. You deferred the tax, you didn't eliminate it. Uncle Sam always gets his cut eventually. Your HSA, for medical expenses, that tax bill is $0, gone, permanently erased. And here's what makes this really interesting. The average retired couple in America will spend over $300,000 on healthcare costs in retirement. That's $300,000 worth of withdrawals that in an HSA are completely tax-free. In a 401k, you're paying ordinary income on every single one of those dollars. The 401k is a great account. The HSA, for the right person, is a better one. Now, if you're a Henry, a high earner not rich yet, this isn't optional. This is step 1 of your financial playbook. Why? Because HSA contributions reduce your adjusted gross income. The higher your income, the more valuable that deduction becomes. If you're in the 32 or 37% bracket, every dollar you shield from the IRS in an HSA is worth significantly more than it would be for someone in a lower bracket. You're already earning well. The question is whether you're keeping what you earn. The HSA is one of the few tools left that legally lets you do exactly that. So here's your action plan. 3 steps. Do them this week. Step 1. Check your eligibility. You need to be enrolled in a high-deductible health plan, an HDHP, to contribute to an HSA. Check your insurance card or call your HR department. Step 2. Open or activate your HSA. If your employer offers one, great. If not, you can open one yourself through providers like Fidelity, which currently has 0 fees and solid investment options. Step 3. Invest your balance. Don't let it sit in cash. Pick a low-cost index fund and automate your contributions. Then start keeping those medical receipts. That's it. 3 steps to unlocking the most tax-efficient account most people have never used correctly. If this opened your eyes, hit the like button. It genuinely helps this channel more than you'd think. And if you want to see the full breakdown of how to build a tax-free retirement strategy from scratch, that video is right here. I'll see you there.